Welcome to The Explainer. So, if you've ever paid a premium for a luxury hotel room and thought to yourself, who is actually making the real money here? Well, today is your lucky day. We're unpacking the Q1 2026 earnings report from Xenia Hotels Resorts. If you're curious about how high-end travel properties generate serious returns, this analysis is going to show you exactly how it's done.
Let's just dive right in, shall we? The central question we're answering today is pretty simple. What actually happens when robust demand for luxury travel meets incredibly disciplined financial management? The numbers we're about to look at, pulled straight from Xenia's May 1st SEC filings, paint a very clear and very profitable picture.
To make sense of this rather complex report, here's our roadmap. We'll quickly cover their Q1 snapshot, RevPAR and margins, jump into some property highlights, check on the balance sheet, weigh the bull versus bear case, and finally, look at their future outlook.
Let's move right into Section 1, Xenia's Q1 2026 snapshot.
Now, before we hit the hard numbers, let's learn the language. We're going to be talking about Adjusted FFO, which stands for Adjusted Funds from Operations. For a real estate investment trust, this basically strips away the accounting noise, things like depreciation, and shows us the actual true cash the company generated from operating its hotels.
And here's why Xenia's Q1 was such an absolute blowout. Their adjusted FFO per diluted share landed at a very strong 63 cents. To put that into perspective for you, that is a massive 23.5% jump year over year compared to the first quarter of 2025. I mean, imagine your own income jumping 23% in a single year. That's the kind of growth we're talking about here.
And that fundamental profitability growth, it's undeniable. Looking at Adjusted EBITDA, which is another key real estate profit metric, they leaped from $72.9 million in Q1 2025 straight up to $81.4 million in Q1 2026. That is nearly a 12% growth narrative, reflecting some incredible top-line performance that's just flowing right down to the bottom line.
So, the headline numbers look fantastic, but what exactly drove them? Let's move to Section 2, RevPAR and margin surges. You're going to hear RevPAR a lot today. It stands for Revenue Per Available Room. It's basically the ultimate hotel metric. It simply combines how well a hotel is filling its rooms with the price it's charging for them. Anchoring our analysis directly in the SEC filings, Xenia's same-property RevPAR hit $205.93 for the quarter. That is a highly impressive 7.4% year-over-year increase. They didn't just fill more rooms, actually. They commanded a 5% higher average daily rate for guests to stay in them.
But look, it's not just about making more money, right? It's about keeping more of it. So the absolutely crucial point here is this number, 270 basis points. Xenia expanded its hotel EBITDA margins from 27% to 29.7%. They pulled this off through incredibly disciplined expense management, all while simultaneously riding those higher daily room rates.
All right, let's step away from the spreadsheets for a second and look at the physical real estate in Section 3, Property Highlights and Renovations. The absolute star of the quarter was, without a doubt, the Grand Hyatt Scottsdale. They recently finished up a transformative renovation there, and wow, is it paying off. Record Q1 revenues and hotel EBITDA. Their same-property RevPAR shot up a staggering 46.2%. It really proves that if you deploy capital into the right luxury upgrades, travelers will absolutely pay for them.
And, it's not just about the beds. It's about the food. Down at the W Nashville, they brought in the renowned Jose Andres Group to completely overhaul their food and beverage outlets. They launched concepts like Xenia and Bar Mar right on time and on budget. Because, honestly, who wouldn't pay a premium for a world-class meal just steps from their hotel room? Leadership actually expects this culinary upgrade to generate an incremental $3 to $5 million in EBITDA over time.
Now, all this operational success needs a rock-solid foundation. Let's evaluate that in Section 4, Balance Sheet and Dividends.
A hotel portfolio is really only as strong as its balance sheet. Now, Xenia holds $1.4 billion in outstanding debt, but here is their superpower. Over 75% of that is locked in at a fixed rate. In a world of unpredictable interest rate hikes, that gives them massive protection. Plus, 28 of their 30 properties have zero asset-level debt, which leaves them with over $600 million in total liquidity to play with.
So what does that all mean for investors? Well, it means consistent returns. Xenia declared a cash dividend of 14 cents per share for the quarter. If they maintain that, it translates to a nearly 3% annualized yield, rewarding shareholders nicely while the company continues to grow.
Of course, no financial explainer is complete without looking at both sides of the coin. Let's move to Section 5, the bull versus bear case.
Looking at some insights pulled straight from Simply Wallstead, we see two very contrasting market philosophies. The bulls absolutely love Xenia's stable cash flow, pointing to that 157.7 million trailing FFO and their focus on top 25 markets. They argue the stock trades below its fair value. The bears, however, they're urging caution. They point to a slower 3.1% revenue growth compared to the broader market, lingering macroeconomic uncertainties, and a higher price-to-earnings ratio relative to the specific hotel REIT sector. It is a classic market battle, strong asset cash flow versus broader economic caution.
So, where is management actually steering the ship? Let's wrap up our data dive in Section 6, Future Outlook and Guidance.
Because of that massive Q1 outperformance we just talked about, management actually had the confidence to raise their full-year guidance. They bumped their midpoint Adjusted EBITDA to $266 million, and they expect Adjusted FFO to jump 10% from 2025 to hit $1.94 per share. And the crazy part? They're doing this while still pouring $70 to $80 million into capital expenditures to keep their properties top tier.
And let's see how this momentum is building into the second quarter. Management noted that this positive trend really hasn't stopped. They estimated that April's RevPAR actually increased nearly 6% year over year. The demand from both big group events and individual transient travel remains incredibly resilient. So, what are they going to do with all that momentum and cash? Well, Chair and CEO Marcel Verbaas noted that the transaction markets are finally looking a bit more robust than they have in the last couple of years. With their clean balance sheet and high liquidity, Xenia isn't just sitting still. They're actively hunting for external growth and potential acquisitions.
Looking at the totality of this May 2026 earnings release, Xenia's first quarter is just a textbook story of broad-based operational outperformance. By heavily investing in smart renovations and keeping a strict eye on expenses, they have managed to squeeze maximum profitability out of rising hotel demand. But I want to leave you with a final thought to ponder. As we saw with the bear case earlier, the broader economy is always a wild card. So, are Xenia's newly renovated, highly profitable properties, combined with that pristine balance sheet, going to be enough to weather any potential macroeconomic storms on the horizon? It's the ultimate test for luxury real estate. Thank you so much for joining me for this explainer, and as always, keep learning.